Hello, this is Joanne Obata. I'm the interim president for the International Model Investment Club, and I'll be going over our introduction and then quickly do the agenda, and then Christopher will be doing our treasurer's report. Then we'll have a brief discussion about our portfolio contest and then get into our quarterly reports. So let's see. Am I showing my screen yet? No. Do you guys see my screen? Do you hear me?
Yeah, we see your
Yeah,
screen.
I can see it, yes.
Okay. So a little bit about our background. We were founded in May 2016. We are a model club open to the public. We have monthly meetings held on the third Monday of each month, except for December, we meet on the second Monday of the month. We use hypothetical money because we have an international membership. This avoids issues with currency exchanges and taxes. Our primary role is to be a learning lab, so we focus on learning better investing principles and the fundamentals of stock investment, using the stock selection guide, and to learn investment operations management. Let's see. All meetings are held online. As I mentioned before, we have visitors and guests from around the world, and we currently have 10 members from the United States, Canada, and China. So I'm going to briefly go over meeting conduct. I don't think I put the agenda in. I might try to put the agenda in the handouts section of the control panel. All visitors and guests will be muted during the meeting and may post questions in the questions section. At the end of the stock presentations, visitors and guests will be unmuted and ask for their comments and questions. Meeting segments are timed. Alerts will signal when the segment is near the end and when finished. This is our disclaimer. The information presented for educational purposes only. Let's see, I want to get rid of this. Can I get rid of these things? Sorry, guys, I'm trying to get rid of my. Okay, so I can see the screen. The views expressed are those of the participants only and do not necessarily represent those of Better Investing. Investors should conduct their own research and analysis before making any investing decisions. Securities discussed may be held by presenters in their own portfolios. This presentation may contain images of websites, products, or services not endorsed by Better Investing or the presenters. This meeting is recorded and will be posted to our YouTube channel. Okay, now I'm going to quickly go to our agenda for this evening. So I just did the introduction, a disclaimer. Christopher will do the treasurer's report. Then we're going to go to our contest challenge, our portfolio contest. We recently had some changes. Then we'll do quarterly/annual reports, and then have an open mic for our guests. So Christopher, do you want me to give you the screen?
Yeah, I can have the screen.
Okay, making you presenter right now.
Do you guys see the treasurer's report?
Yes.
Okay. Yeah. So let's go over our recent motion. So over the past month, so we bought 10 shares of NICE, which comes down to $1,660. And then we asked if anyone owned Paychex or PayX, because we were thinking about selling it or stop following it, but we do. Some members do own it, so we're gonna continue following it. And then we sold IPR. Ready needs to present the sell checklist, and then we bought 4,000 of TSM because it dipped, and that came down to 20 shares. Yep. And then our cash transactions. So member deposits for this month is plus 1,000. And then we bought 10 shares of NICE, which was the $1,660 that we mentioned earlier, and then the $4,000 of TSM. So now we have 7,178 and 70 cents worth of cash left. Okay, so our valuation statement, yeah. So here we can see all of our portfolio. We can see that Meta is a little bit like more of a portfolio than the others at 11.4%. The rest are below 10%, right? IPR 4.7%, and we're trying to sell that. Paycheck's up 5.6%. We're keeping it, but we're also kind of on the edge on that. TSM, I don't know if this includes the new amount that we bought. I'm assuming not, because it's only.
It does. We just bought a little bit
Does.
of it
I
a couple
see.
of months ago. So I think this is the total amount.
I see. So we originally had like 2,000, I guess. Okay. Okay. Yeah. So yeah. So let's look at our sectors and companies. So mostly we're very heavily invested in tech. Even communication services are like tech, right? Because it's like Meta and Google. So yeah. So we can see here the companies, and then we still have a decent amount of cash, 7.7%. So we can think about using some of that. Yeah. Let's see. Okay, yeah, and then some market observations. So we can see like the kind of like the historical trend of like the market over, so this is over the past like century and a half, right? Yeah, so there's like the stock market crash in 1929, and let's just look at more recent, right? So there's a dot-com bubble crash, the financial crisis, and then here maybe there's and then there's like COVID-19 as well over here, right? That was part of the dip. And then maybe there's a Trump trade war, which will cause the dip. We don't know. It's kind of hard to know, but it's a possibility. So just putting it out there, especially with the P ratio being kind of high, right? Maybe there's a reversal. Yeah, and then here, kind of want to talk about equity risk premium, which represents the additional return investors expect from equities over risk-free assets. And recently, this has reached notably low levels, particularly in the US. And the reason why people think this has been like a lot lower is that the forward earnings yield has decreased to 3.9%, right, due to high stock valuations. And then the bond yields has also increased to 4.65%, which offers more attractive returns considering it's a risk-free asset. So yeah, so why is the ERP low? So again, right, S&P 500 is trading at like very high P ratios, which means that the expected returns is a little bit lower, right? And then investors anticipate Fed cuts, which reduces perceived risks. So this means that lower rates make stocks more attractive relative to bonds, so which reduces the perceived need for a high risk premium, which is why the ERP is low as well. Yeah, and then next, strong earnings and AI hype. So large cap tech and AI related companies such as NVIDIA and Microsoft have been driving market gains, which lead investors to believe in strong future earnings growth. But if earnings growth is perceived as stable and predictable, investors also require lower return for holding equities, right? Because they think that it'll go up regardless. They don't really care about the price. They just keep buying in. So they don't really care about the premium. So it's lower. So, and then next, there's a low market volatility. So the volatility index, VIX, has been low, which indicates that investors see little near-term risks. Where markets remain stable, investors become complacent and accept lower compensation for risks. And there's also the Fed put mentality, expectation that the Fed will intervene if markets fail. So investors believe that the Federal Reserve will step in if markets fall too much, even though rate cuts or either through rate cuts or liquidity injections. This perception lowers risk expectations, which also reduces the risk premium. And then lastly, the TINA effect. TINA stands for there is no alternative effect, which is weakened but still present. So even though bond yields has risen, investors still see stocks are the best option for growth over the long term, especially over the past couple years, I think, where the average rate of return was like 20-something%, 30%, which is kind of crazy. So even if the risk-free rates are higher than before, optimism about equities still keeps the ERP low. Yeah, so what's the risk of a low ERP? So a low ERP suggests that markets are not pricing at much downside risk. So if something disrupts the current optimism, so like if there's like any big event such as inflation surprise, geopolitical event, trade war, or weak earnings, the risk appetite could shift really quickly, which leads to a sharp correction. And yeah, and here's a graph showing Yahoo Finance, like their anticipation of like what's going to happen. So the Magnificent Seven's earning advantage is expected to slow down in the next year, and other companies are expected to like rise a little bit. But yeah, that's it for a treasurer's report. Any questions, comments?
Are there any questions for Christopher? Okay, let's move on. I'm going to show the contest, that portfolio contest, and Mel, Mel and Piero, you can probably talk about this. Okay, so this is us now. I don't know, Piero and Mel, were we down near the bottom before our change?
Yes, we were we were at like 97,000 before we made the change, and the one stock we originally had, Amphastar, the pharmacy, it really took a dive.
Okay, so it took us.
Right. So if you look, I don't know if you can. Well, I guess we don't have that anymore, but most of our other stocks, Viva, we had Micron, and what else did we have? We had Copart. Most every other stock kind of held its value. In other words, it maintained. Some went up to 22,000. Some kind of hovered around 20,000. And you can see the 12,000. Let's see, there we go. For VRT.
Yeah, what is that?
Okay, Vertiv Holdings. What Vertiv Holdings is, it's an industrial company that's big in the infrastructure, in the data center infrastructure trade. In other words, it handles the electronics, the cooling of the racks, and it's been going great guns. And in our discussions, in our group discussions about what we should do with Amphastar, we said we really need to get rid of Amphastar because it doesn't look like things are going to go too good for it. And VRT, Vertiv Holdings, is just going great guns. So now it's, we're looking, this is not like a long-term holding. It's one of these stocks that, for example, Value Line rates at number 1. We're expecting it to, do quite well over the next year as all of the hyperscalers are putting in all that money, all that CapEx to build out the data centers. So what happened when we made the change, then they substituted the same amount of money, Amphastar, for VRT. So now our hope is that as time goes on, we'll see this increase.
Okay. And I think the contest ends in either July or August. So this is really super short-term investing, and this is like, this is very non-standard for Better Investing Principles, because Better Investing does long-term investing. I think it's 5 years or more. So
Right.
this is a kind of a experimental exercise for us that we're doing, looking at. I mean, these are stocks that we would maybe possibly want to invest in, but they're so, because they're so, aren't most of them pretty small?
Right. And, you know, that's the mindset we had. Okay. Now, I did include as a watch list edition, I did include VRT. It's something you wouldn't want to buy long term necessarily right now. But again, our mindset was, you know, by the middle of the year, that's when the contest ends. So that's kind of the mindset we had. And the other changes, not to belabor the point, we noticed that Micron technology was, I don't know, flat, or, you know, especially after the DeepSeek announcement going nowhere. Marvell is another one where it's got a high PE, but it does the same kinds of chip design as Broadcom, but it's a small cap. And so we substituted Marvell for Micron. And we kept Vive and Nice. Nice we owned long term, okay? And Vive is in our, I think it's in our watch list. So we kept Vive and Nice. And then Haney did a study about, you know, stocks that are rated to go do very well over the next year and also the next 6 months. You know, that's that third item in value line, which is really a technical index, and it says, hey, what's going to happen? What does value line think's going to happen 6 months from now? Okay, well, that's the time horizon for this contest. And airlines, we scratched our heads, but airlines seem to be doing pretty good, especially Delta Airlines. And as you could see, of all of our holdings, at least as of today, or actually Friday, its value is higher than all the other ones. So anyway, that's the story on the changes that we made from the original list of stocks.
And then I have a question. Did you look at any of the other contest holders? I think, let's see.
Well, yeah,
I think Two Rivers is at the lead with 180,000, you know, but I think they're.
We weren't going to jump on Palantir. And to answer your question, Joanne, we did not study the other groups.
Okay.
All right.
Okay. I think this is a really interesting and kind of fun project that you guys are doing. I mean, just, and also being able to look at the other people and what they've selected. Some people really kept their holdings like this. Richard only has 4 holdings. I think you can have up to 7. So I just think it's interesting what people actually chose for their stock selections. And this person picked like all the kind of big Adobe, Meta, Amazon. I think these are all, you know, NVIDIA's pretty fast growing. And I'm not sure how many people actually did stock changes. Did they tell you that?
I don't know. You know, we basically did not study what others were doing. And we noticed that, for example, stocks like NVIDIA, Microsoft, a lot of the hyperscalers, they pretty much leveled off. And how much growth do we expect here in the next, let's say, 6 months?
Mm-hmm.
And so we just didn't go down that route. We looked at some of the ones like Vertiv Holdings, which doesn't matter who's building the data center, whether it's Meta or Microsoft or whoever, they're going to need the services and equipment from Vertiv Holdings. So we just thought that the story behind that stock was pretty strong, and that's one of the reasons we bought it. And likewise with not Micron, but the other chip stock that we have, Marvell. So
Okay.
anyway, we'll see how we do.
Okay. Thank you. That was very. And thank you very much for reassessing our portfolio and updating it. Hopefully that'll bode well for the next, end of the contest. Okay, so next we have quarterly and annual reports. Jane, did you want to go? Jane, you're self-muted. Do you want me to make you?
Yes, please.
Okay.
All right. Good evening, and can you see my report?
Yes.
Okay.
Can.
All right. I'm presenting Vertex, and the annual report was issued on February 10th, and we have been holding Vertex since 2020, December, the end of 2020, and we purchased at about three slots, and we started selling it and realizing the profit since the end of 2023 after 3 years of holding. And we first sold 8 shares, and we realized at the share price of $404, and we purchased at the beginning it was at 200. So after it doubled, within 3 years, then we start selling. And then we sold again last year, September, and we sold it at a pretty high price, $481. So now we are down to 16 shares, and the cost is about $3,500. And Christopher just presented the holding constituting about less than 8% of our total portfolio. So that's the right size that we are downsizing to. And currently, the share price is 459, slightly lower than what we saw at in last September. And the 52-week high price is about 520, and it declined to about 377 in the middle of December last year. And I wish I catch that, but then anyway, but that was a good price, entry price, if we bought in at the time. But it quickly rebounds to 400 something, so it didn't leave us much time to add our position. Yeah, and the current PE ratio is 30.5. I will show you the SSG. Yeah. And as you all know, this year, I'll show you the value line report. Oh, here we are. Yeah, as you know, this year, Vertex has acquired a company called Alpine Immune System in Q2, and Alpine has a bunch of research and development expenses, huge amount. So they inherited that, and so that was a a loss for that quarter. And then I adjusted back to show the actual. So I adjusted back, adding that back, so that would be a more recurring quarterly EPS. So I adjusted this, as you can see, so you can tell better. Otherwise, you will screw up the trend line. So I anticipated the sales growth for the future 3 to 5 years is 11.5, and that's based on the most recent earning release. Sorry, the most recent earning release. Bear with me, sorry about that. Yeah, that's based on most earning for the fourth quarter and full year earning release. Yeah, here we are. Okay. Yeah, this is the earning release for this quarter, fourth quarter, as well as the full year. And as you can see, the product revenue has been steadily increasing, and they have been increasing the guideline for the revenue for the past 3 quarters, and for the next year, further increase. So based on the last 3 quarters, the earning has been steadily increasing in the range of 11 to 16%. So my projection, because the value line most recent report has not been issued, and the last one was November, so that is not a very good representative. And so the most recent one will be issued in March, the beginning of March or the end of February this year. So I go ahead and use 11.5, which I think is a reasonable growth rate for sales. So I use the preferred procedure to arrive at 11.2 earning per share growth rate. And basically, I look at the past trend, and so I look at pre-tax, and I selected the most conservative amount, and the taxes I base on the projection for 2025 that I pick 21% as a tax rate. And for the outstanding, shares, I just pick one that is close to current outstanding rate. So I come up with 11.2 as the earning per share growth rate. And as you can see, the return on equity is increasing, but then increasing for this year, even though it dropped last year. But then the pre-tax profit has declined slightly. And that's because there are a lot of expenses, including research and development expenses. Not only the acquired entity have that, but then VRTX itself organically, to achieve organic growth, it has put in a lot of research and development expenses, and plus other expenses. So the expense growth rate is increasing at a higher rate than the sales growth rate. So the pre-tax profit has declined slightly this year, and the debt to capital ratio, this year the debt to capital ratio also increased slightly higher than past few years. So based on the sales growth rate of 11.5 and the earning per share growth rate of 11.2, I come up with a high price estimation. I take the high PE, I take 80% to come up with 23.4 of the 34.5, and then I take 25.1. I take 20.2, 29.3. I take 29.3. I take 90%, 80%. 29.3. I take 80% of 29.3. 5-year average high PE. I come out with 23.4. And for the low PE, 20.2, I just went ahead and used 20.2 as the low PE to come up with my low price of 303. And then this 25.61 is based on my adjusted earning per share for this year. And I take 11.2 earlier, we see 11.2% growth rate. And in 5 years, the high price will be 599, which is comparable to Goldman Sachs target price next year, as well as the value line November report, which I will show you. And so based on that, high price of 599 and a low price of about 300, we have a hole for Vertex. And before we get into more further, we look at our annual summary report. So this is current PE ratio of 30.5. I'll show you. Yeah, so all this data of PE I collected from the our SSG. Okay. And then we go on. So we also, for annual report, we also look at the financial statements closely. This year, I didn't do the 5, 4, 3, 2 observation, but Vertex, as usual, it has a financial health standing of A+ according to value line. Okay, so it's a very healthy, financially healthy company. And so I collected all this from the annual report. So Vertex is consistently increasing its sales, and this past year the sales growth has been 15.7%, and last year was 11.7. But sorry, this recent quarter is increasing up to 15.7, but this past whole year, full year, is 11.7%. And the current ratio, which is the current asset divided by current liability, it has decreased to 2.7 from about 4 the last year. But it's still it's a healthy current ratio, and that's why it has an A+ financial standing. And the free cash flow mainly for the year is because of the acquisition and the high research and development, acquired research and development expenses is caused by that. So this is the calculation of the net cash position that you can see. Yeah, so we have a huge amount acquired in process research and development expenses from the acquisition of Alpine Immune System, which is like 4 billion. Yeah, it's compared to usually Vertex about 520 million usually. So the historical sales growth rate, as you can see from SSG. It's 29.9 for the past 10 years. And if you take off 5 years, that will give you 15.2. And quarterly is 15.7. Yeah, anyway, so 15.7, you go here to see the quarterly. Yeah, you look at the quarterly, and you would see the quarterly sales increase. Yeah, it's 15.7. That's how you got that. And then for the trail 4 quarters, you get the 11.7. So you collect all this data from the SSG. And again, the earning per share, you did the same thing. And for quarterly, they compare to the last year, quarter 4, then you have -5 because you have 3.5 in the last quarter. Last year, fourth quarter is 3.71. So you have a -5% decline. So the diluted shares outstanding is about the same from last year. So this is, yeah, okay, it's about the same from last year. Yeah, and then as I mentioned earlier, the return on equity is increasing, but the pre-tax profit has been coming down slightly from the 5-year average. So overall speaking, VRTX continue its great sales growth because of its a main medicine. This CF, the cystic fibrosis medicine, this Trikafta, it's continuing doing well in not only in the US but also all over the world, in Europe, in Arab, everywhere. And so it continued to do well, and also it has a very diverse pipeline. Yeah, as you can see, this is on their presentation, and the pipeline has different type of medicine, and it has been doing well, not only in the phase 1 and 2, it has some late stage developed medicine in 3. And so recently on December 20, they just received FDA approval for this Alif track. This is another I would say enhanced medicine for CF treatment, the fibrosis treatment. It's another. I think I really admire VRTX is that it's not only focusing on CF treatment therapies, they continue to innovate and develop new medicine for their main medicine, CF therapy, but they also branch out to different areas that they have gene edited cell therapy, and so all this like they are doing really well, and they also have developed some medicine to cure acute pain in different areas of the body, and they also just last month they got approval for this medicine for the treatment of acute pain. So of course, in order to achieve this diverse pipeline of development of the potential medicine candidates, they put in a lot of research and development expenses, and so that's how they come up with different kinds, as I mentioned, kidney disease. They even have type 1 diabetes medicine that in the pipeline. So, but and this past quarter, Two, the deficit, the earning deficit is mainly due to the acquisition relation to the Alpine Immune Sciences, not System Sciences, and so that's how I added that back to show you a better SSG. Yeah. So the revenue guidance for 2025 continue to increase, and is now 11.75 to 12 billion. And Goldman Sachs has increased Vertex 12-month target price from 590 to about 615. And even the most updated report, it's not the updated one, it's November. The November value line report, I'm sure the target price will continue to increase, but even the November target price for value line is 547. Yeah. So based on my projection, currently Vertex sitting at the whole zone, but I'm not recommending to sell it. It's because we have been downsizing it to a reasonable position in terms of our total portfolio, and I look at potential that will be coming out of this diverse pipeline of developed medicine. So I think we should just hold. And also the price has dropped from 519 to 460. So I don't think this is the time to further reduce our position. Perhaps if we observe for a few weeks, a few months, we can either add more if it go down, the price go down, or we can sell some more when the price reach or beyond 500. So this concludes my presentation. Any question you may have?
I have a question, Jane. So you made an adjustment, was it to the EPS on
Yeah.
and so can you remind me why you did that instead of just striking out the year or the quarter for that? Why did you?
I did that because this is a one-off acquisition, right, in second quarter. So I added back.
So, and where did you find the number to put in there?
I just added back. Oh, sorry. Here. I look at the annual report. The annual report. Let me see. I look at the 10K.
Okay.
I search for the financial statements, and I look at the income statement, and I take
So should we be doing this anytime there's a acquisition?
No, I'm not saying that because it's a very one-off thing, and I just thought it would be better to show the trend line a better shape, and also it's a one-off thing. You know, it's basically because it's a one-off thing, and I just did that, and it doesn't really affect much about our SG, except that you can see it better. You won't see that the wheel dipped in the second quarter.
And so the drop was due to the acquisition then?
Yeah, the acquisition, they inherited the research and development expenses I mentioned earlier.
Oh, the 5 billion or?
Yeah, the 5 billion.
Okay. All right. Thank you.
Yeah, sure.
I have a quick question. Internationally, how are they doing? How's Vertex doing?
They are doing really well. They got approved for a bunch of reimbursement agreements in Europe, and they They even branch out to a lot of countries, like if I remember correctly, they branch out to Arabic and different countries. They are doing really well. Actually, if you look at the earnings release earlier, it does say that their out of US sale growth is even higher than the US sales growth. Let me see.
Looks like no sales to China, though.
Oh yeah, no sale to China there. No sale to China yet. Yeah. So if you look at yeah. Oh, okay. So it's
Right.
yeah, the outside sales growth rate is about 14. Yeah. Yeah. Oh, so it's comparable, not higher than the US sales growth rate. Yeah. The US sales growth rate is about 17.
Okay, thanks.
Definitely catching up. Yeah. Any other question? When I do HG, I tend to be more conservative, and I don't like to put in big number, and so that we will not be able to objectively evaluate. So that's why I try to take discount from the 5-year average PE, high, especially high. For the low, I depends. I look at this low, it's quite reasonable because 303 is far away from our current price of 460. So I just go ahead and use the current PE for low PE. Yeah. Any other question? Okay.
Wait, I have one more question, Jane. So I noticed you used 80% for the average high PE. I thought we usually use the 80% for the forecasted low price, but we can use that for the average high PE too?
Yeah, of course. You can always use high and even low PE. You can, I mean, it's not a rocket science, it's more an art. It really depends on how you proceed, and you look at the prospect of the company and things like that. Yeah.
Okay. All right. Thank you. I think next we have, is it Christopher? Do you have a? Let's see.
I have Meta.
Oh, no, wait, it's Piero's next. Piero, are you ready? You're self-muted.
Yeah, Jake,
Okay.
Gwen. Yeah.
I'll make you presenter, Piero.
Okay.
And then we have Christopher, and then Isla's not here yet.
Okay. Let's see where to start. Yeah. Okay. Okay, might as well start here. Okay. So this is the annual report summary. Okay. I still have Megumi Yamamano as my peer reviewer. I don't know. Should I take that off or just
Take that off. You can take that off.
Okay. Let me do that right. Oh, shucks. Right now. Okay. Stock price is about $233. So $230 now. It was a little bit higher before February the 7th. It was up to about $240 at February the 6th. Actually, on the 7th, the price went down a bit. I think everybody heard that. Okay, so 52-week low, 151, 242. Yeah, about 240. Went down about 230, 228 right now. Current PE ratio is about 41, which is high. 5-year average is 42, so it seems to say it's slightly less than fair value. 5-year average low PE 34, 5-year average high 51, which is anything above 30 is considered high. Revenue 187, current fiscal year fourth quarter 187,000, and last fiscal year fourth quarter 169,000. So it was an increase of about 10%. This is kind of an interesting number, which will be interesting later. Current fiscal year, the entire year was 637. Last year was 574, which is again about an 11% increase. Again, that'll be interesting later. Balance sheet, there it is. Total current assets, 190. Last year's current assets were 174. So I guess that's an increase of exactly, it must be something like about 10%, something like that. Total current liabilities, 179, 164 last year. So the current liabilities went up a little bit. Long-term liabilities, I assume. Current ratio is 1.06, which is a little bit low. It should have been around 2, current ratio. Quick ratio should be around 1. Current ratio should be around 2, so it's a little bit low. But the interest coverage, I think I read on Morningstar, was something like 4 or 5, something like that. So they can cover 5 times their interest charges. And as they were writing on their 10K report, they're a retailer. So they take things in, buy things from their suppliers on credit, and then they sell it. The account on the buyers of that product to pay them so that they can in turn pay their suppliers, and they play that game, that slight difference there. So that might come up later on their stock holdings and accounts receivable, accounts payable. Okay. Free cash flow this current fiscal year was 32,878. Last year was 32,217. Similar, generally positive to steady. Results. See, historical sales, 10-year about 22, 5-year 16, quarterly 10.5. See, trailing 4 quarters about 11. So around about 10% overall for a large company, which is kind of interesting because it's almost $1 trillion company and they're having sales of about 10%. A medium-sized company would have sales of about 10%. But Amazon is a huge company. Okay, sales forecast for the from last SSG was 10. The current SSG is also 10. All right, and one of the reasons behind that, I'll show you one on my SSG, is that when the facts are the same, your projections should remain the same. When the facts change, your projections should change. And we'll talk about that after we get to the graph on the SSG. Earnings, historical earnings, I guess was 10 years is 22%. Last 5 years, it's been about 2.1%. A quarterly is about 86%. A trailing 4 quarters, 90%. But that's coming off, lows of the 2021. Earnings forecast from last SSG 18, and this SSG is 18. Facts remain the same, projections remain the same. Diluted shares outstanding are very similar. This year it's 10,721. Last year was 10,492. Very similar, so they're not diluting shares, diluting the value of shares that we're holding. Okay, evaluate management. Pre-tax profit margin is up. Return on equity also up. And debt to capital is slightly down, and that's what we want to see. Okay. Then here I talked about some of the things that Amazon has done, on their what's it called, the final reports for the 2024. Some of the things that they've done and that are interesting and all that kind of stuff. Then for next year, now next year is the interesting thing that the price dropped mainly because of forward guidance. Next year, what they intend to do I could show you a little article here that was written by Jassy on his call transcript. And what Jassy is saying is that on the CapEx side, we spent $26.3 billion on capital expenditure in the fourth quarter of 2024. And I think that this is reasonably representative of what you could expect in the annualized CapEx rate in 2025. So what he's saying is that in 2025, they're going to spend about $26 billion every quarter. That's more than $100 million for the entire year 2025. When they spend that kind of money, that means their earnings are going to go down to nothing. Their profits are going to go down to nothing. Okay, so that's what the investors were scared of. Like if they looked at this and they said, oh my God. So they started selling, right? And the price went down. Now, Jassy goes on to say that the vast majority of the CapEx spent is on AI for AWS. It's the way the AWS business works and the way the cash cycle works is that the faster we grow, the more CapEx we end up spending because we have to procure data center and hardware and chips and networking gear ahead of when we're able to monetize it. That's a rationale for spending all that money. Okay, let's get back to where we were. Okay, so there's that. I guess we can go. Let's get rid of this. Okay. Well, I guess we could do this. Okay, analyst reports. Okay, well, this is the quant report. Interesting here, one thing that's interesting here is that the 1-star value that they give has a wide moat. 1-star value is $270. And 1-star value means this is the price about as high as it can go because they give 5-star ratings. 5-star means there's a lot of upside. 1-star means there's little upside. And so the top price is about $270. And I think on the other report, they say the fair value should be around $280. So I would say that the sell price is around $300. Anywhere near $300, sell it. Anywhere near $100, buy it. That's for Amazon. So there's that. Let's go back here. Oh, okay. Let me take this is the more interesting report. Okay. Okay. This is they're just outlining some of the things that they produce. The two key segments in Amazon is AWS and advertising. So AWS expanded about 19%, advertising expanded about 18%. Okay, so which is, these are the more profitable, the ones with the higher profit margins, the segments with the higher profit margins in Amazon. They're the ones that are kind of driving the earnings and the efficiencies and all that. Okay, let's see, operating margin was about 11.3%. Now, the interesting thing is about, Amazon overall is a retailer, just like a grocer. In a grocer, their margins are about 2-3%, right? And retailers in general, their margins are about 5%. Amazon, a huge company, their margins are 11%. And I'll show you the value line report, and it says that their margins, their profit margins, went from about 5% to 8% to 9% to 11%, and they just keep getting bigger, which is kind of an interesting phenomenon because when companies get bigger, they're typically their profit margins decrease because it becomes much harder to control the expenses in a larger and larger company. But Amazon has found a way to do it, and they're becoming more profitable as they get larger, which is unusual. Okay, so we'll go down here to about page 7, page 8. Here they have little nitbits that knickknacks that you can kind of look at and are kind of interesting. I think this interesting is on page, that's 5. What is it? This is page 7 at the bottom. At the bottom of page 7, it says we model total retail related revenue growing at about 8% compounded annual growth rate at over the next 5 years. This is retail related. The retail segment of the company is going to grow at about 8%, which is, impressive. Then the next one here, over the next 5 years, we project AWS revenue growing at about 16% compounded annually, advertising growing at about 17% compounded annually. So the two more profitable segments of Amazon. And then total, Amazon should grow at about 10% compounded annual growth rate through 2028. We model a GAAP operating margin expanding from 11% actual in 2024 to approximately 13%. Operating margin will go up to 13%, not 11. It's going to go up to 13%, which is, very, very strange for a company that keeps getting bigger. Okay, and a lot of that is going to be driven by the AWS and advertising. The advertising in, what's it called? Meta has advertising, Google has advertising, but the Amazon advertising segment is much bigger. Okay, so we can kind of go back here. I think I can do that. Okay. Value line, the thing about value line is that Amazon reported their earnings on reported their earnings on February the 7th, but this one here, the latest report I could get from Value Line was January 31st, right? This was after the fourth quarter, January 31st, 25. This was after the fourth quarter. Oh yeah, I guess this is kind of thing. Yeah. Okay, this was issued before they reported in February the 7th. They didn't see the last report for the fourth quarter, so I guess they're working on the third quarter results. But kind of interesting in that, what's it called? Recent price 225. Projected PE ratio 39.6 at current, and their average annual PE ratio, if I can see it from here, average annual PE ratio is going to be about 39.5. So it's going to be about the same. So the triple play here is not exactly in play, but it's close. Net profit margin will expand to 9.4%, whereas the profit margins in the past have been 8, 5, 1, 4, 5, 4. So their profit margins are improving, and we know why, because of Amazon, because of the AWS and advertising. Also, their electronic retail, online retail is also doing fairly well, as we'll see later in the reports. And their quarterly projections are going to be revenues. If you wanted to think you grow at about 11%, I said 10. Earnings, they're going to make it grow at about 24%, which I thought was, high. So I said 18. Okay. And the price is slightly suppressed because here projections are 16% projections, which normally growth rates in the stock market are about 10%. So if they project that the growth rate is going to be about 16, it's slightly depressed. And that's part of the triple play. Okay, so we can get rid of that. Okay, now we're back here. These are the TR reports. And the TR reports, average score is 9 out of 10, pretty good. A 3-month return, 12.5%. Long-term forecast, 18%. I think this is for earnings, and that's what I said, 18%. So it looks pretty good. Okay, get rid of this. Let's go to, okay, go back here. Company reports. Okay. These are the conference call slides. This is what they reported as for net sales overall company. Overall, it increased. It increased about 10%, 11%. Okay. Okay. Then net sales for the entire company also increased about 11%. We saw that. Operating income, I guess this is for the entire company, that was up about 61%. And when we get to the bottom of this screen, we'll see the next screen, we'll see why. Operating income, trailing 12 months, also up very high. So that net income doubled. Okay, we saw that. Yeah, net income, again, it's also doubled, all quite doubled. The entire company segment results, North America did about 10%, operating income about 43. Okay, the international, this was the kind of the sickly brother. There it is, sickly brother. Their first quarter of the fourth quarter of last year was about negative, slightly positive first quarter 24, smaller in second quarter. Yeah, it looks like it's going to be profitable going forward, perhaps, we hope. Segment results, AWS does great. Their sales are up about 90%, operating income about 48%. Okay, free cash flow. Free cash flow, yeah, it kind of, is okay, 4% over the whole year. It's kind of okay, but the spending next year, when they want to spend about more than $100 billion throughout the whole year, the cash flow is going to go down to 0. We'll keep that in mind. Free cash flow less principal repayments of financial leases and formula. Okay, their expenses, again, it's small. Cash flow less equipment, finance leases, principal repayments, and all other finances. Again, it's going to be slight, but next year it's going to be a disaster. Shares outstanding are almost essentially the same. They went up slightly, so they're not diluting the value, shareholder value. Okay, these are reconciliations numbers that they initially issued, but kind of walked back, or they reissued them once they had seen the books and recalculated them. So it's not that different. Okay, all that. Okay, so get rid of this. And now we'll go to the next one. That's interesting. This is a 10K. This is quarter 2024. Oh, I think this is the earnings call transcript, which we read already from it. Web slides. This is Amazon fourth quarter results. Okay. Where did I do that? Okay. Anyway, the holiday shopping season was the most successful yet for Amazon 2024. Okay. Oh, shucks. Okay, first quarter 2025 guidance. Net sales are expected to be between 151 and 155. Okay, in other words, between about 5% and 9%, about 7% growth. Investors have gotten, kind of greedy, and they gotten used to being sales growth being about 10%. Now they're telling us that next year it's going to be about 7%. So that was one reason why the price went down. Operating income is expected to be between 14 billion and 18 billion. All right, so it's to be about 16 billion compared to 15 billion in the first quarter of 2024. So again, only 1 billion higher than 2024. It's a bit of a disappointment, but it's a bit of a disappointment because next year they're going to be spending more than $100 billion throughout 2025, and that's where all that income went. Okay, so forward-looking statements. These forward-looking statements are inherently difficult to predict. Okay, it's interesting. Okay, I don't know how to get rid of this thing here, but I don't know. Okay, which is this? This is a statement of cash flows. Oh, my highlights you can't see. Okay, I think with the cash, with these financial statements, the way you should read them, the order in which you should read them is the income statement, cash flow statement, and the balance sheet. The income statement tells you what's coming in. cash flow statement tells you, you know, where the money is going, and the balance sheet tells you what's left over. So that's the way you should read it. So let me see here. This is segment information. Let me see here. Balance sheet. Where is this? No, that's it. Okay. Statement of operations. Okay, that's the income statement. Products. Okay, here's a highlight. Total operating expenses were from 537 last year to 569. That's a difference of about 5% expenses, right? So 5% expenses. Keep that in mind. It's cash flows. Okay. So 5% expenses, and the total income. Other comprehensive income. Our total income went from about 31 billion to about 62 billion. So they essentially doubled their income for doubled their income here, net income, doubled it essentially for 5% increase in expenses. So the expenses increased 5% for 100% boost in income. That's pretty good. Go back to the cash flow statement at the top. Yeah. Okay. See what they're doing here. Stock-based compensation was less this year than it was last year. This year is 22, last year was 24. So they're doing that better. Inventories. I think this is last year were 1,449. This year is less. They mean things have moved. He said it was one of the best Christmas seasons ever for Amazon. They moved so much stock that they were left all essentially empty. Okay, accounts receivable. Accounts receivable last year were 8. This year was 3, meaning they were getting their money. All right. They're getting paid on time. Net cash provided by or future. Cash flow went from 49 to this year to 94. No, these are payments that they made. This is the payment last year, but this is the payment this year, which in the last quarter of 2024 they paid out $26 billion. So that accounts for a lot of that big deficit. We already saw that. Here I can't see the highlights. Net cash provided by. Okay, yeah. No, I don't want to add a comment. Go away. Okay. Okay. This is comprehensive income. Yeah, comprehensive income. We doubled it in 2024 as compared to 2023. Segment information. North American segment operating income. Again, you know, went from 14 to 24. International went from negative 2,000 to a positive 3,000. We already saw it on the slides, the graphs. AWS operating income went from 24 last year to 39. Now pretty close to doubling it. So it's one of the profit drivers for Amazon. Consolidated statement 30 to 15 to doubling it. The income, we saw that. Let's see, total current assets went from 172 last year to 190 this year. It's more valuable. Other total assets, yeah, went from 527 to 624. Current liabilities went from 64 to 179. That's only like a 5% increase. Okay, what is it here? Total stockholders' equity, that's us, went from 201 to 285, which is good for us. We're gaining value. Go to the next one, the last one here, which is interesting. This is the online stores. They were about 7% profitable, increased 7%. Okay, physical stores, the increase about 8% income. Third-party sellers is about 9.5%. That is actually an area where Amazon is putting money in, trying to make it easier for online sellers. One of the things that Amazon is doing now, and another revenue stream for them, is providing their logistical services to third-party sellers, online party sellers for Amazon. They're providing logistical services for them in that they will pick up merchandise in foreign countries, store it in their Amazon warehouses, and arrange for the shipment of it, and arrange for the delivery of it back in the US and North America, wherever they're located, and they do that for a fee. So they're making money off of that service that they're providing. Advertising services grew at about 18%. Subscription services increased about 10%. AWS increased 19%. Okay. And interesting here, employees, full-time and part-time employees, they increased at about 2%. You know, in comparison to last year's first quarter to last year's fourth quarter to this year's fourth quarter, they increased employees by 2%, and they doubled their profits, doubled their income. Now, the interesting thing in one of their conference calls, you know, Andrew Jassy says that they have a model fulfillment center in Shreveport, Louisiana. And in there, what they're doing is they're building robots that Amazon constructs and using these robots to staff their warehouses. The robots are much more efficient. The robots, you don't pay, you just buy them, and then they work forever without pay. And what they're doing, they're reducing their human staff so that you have counselors and advisors and whatever, much reduced the number. The employees that go out and actually pick items off the shelves are going to be the robots. And that's what they're projecting in the future. That's how their model fulfillment centers are going to be. Okay, this is that. We can get rid of this. Okay. This is the earnings reports call. I think we've already seen that. This is 10K. We can look at that if you like. Okay, now I guess we can go back. Okay, so we've gone through that. I guess we might as well go to my SSG. Okay, SSG here, this is the projections that I made were 10% for sales and 18% for earnings. Now for the sales projection here, these forward-looking quarterly estimates or that I made, they're showing up because you choose it here on the sales detailed estimate, things per share detailed estimates. You show that, and they're lining up almost exactly for the way that the Morningstar projections have. So if these facts are coming out true, don't change the projections. One of the things that I noticed in some of our sources, for example, Yahoo Finance, they no longer give 5-year estimates. Now they've reduced their estimates for earnings for 1 year. And most of the sources that we use to get estimates for, they're reluctant to give long-term estimates now. They're giving 1-year estimates. So, but you know, our SSG demands a 5-year estimate. But if you take a look at the sources where we're getting our information to project 1 year's estimate out to go out to earn, say, $5, and our projection for 5 years denotes a 1-year estimate of $5.52, then you know that your 5-year estimate is a little bit too high. So this is how we can use that 1-year estimate to still make our 5-year projections. Because if you take these choices, click the graph items about earnings per share detailed estimates, and shows up, you know, and our estimates are constantly overshowing what the Morningstar professionals are projecting, then we know our 5-year projections are too high, so we can lower them. Okay. Okay, so here, everything is looking here. Pre-tax profit looks good. Return on equity looks good. Debt to capital is going down. That looks good. Okay, valuation and return. What I did is I assumed a high PE of about 40 because price earnings ratio, the tendency is to go down. The most current recent trends will continue into the future for a particular for a period of time anyway. So if you make your projections from current trends, they're inclined to be right. But if you make your projections from out of the air, not based on current trends, you're probably going to be wrong. So the current trend is to go down, and I went down to 40. The same with the low PE. The current trend is to go down, so I went down to 30. The trailing 12 months earnings per share is 553, and that's automatically inserted in here for the low price estimate. Low price estimate is going to be 165. High price estimate is going to be 500 approximately. Okay, and that's going to be an upside downside ratio of about 4 to 1. It's in the buy zone, but I wouldn't buy it. Our initial purchase price was $161 about 5 years ago. If we sell it now, like 230, we're going to make about 40 bucks. Not really good. If we sell it around $300, that would be probably doubling our money. Okay, so it's telling us to buy, but I would hold. Potential price appreciation, 121%. Okay, I think the return, if we sell it at 300 and we bought it at 161, it would be almost doubling our money, and that's what Better Investing wants us to do. Upside downside ratio, yeah, you don't pay a dividend. The compound annual return using the forecasted high PE is going to be about 17% annually. Compound annual return for the average PE is going to be about 14. So close to what, even on the low, it's close to what Better Investing wants us to achieve. Okay, quarterly data, not really necessary to see that. Ratios, current ratio is 1, it should be a 2. Quick ratio is 0.6, but it should be 1. But interest coverage is about 4.4. So there's no problems about going insolvent. No one's going to call their debts on that. The PEG ratio is 1.9, which is high. At 1.5, it's beginning to get a little iffy. Notes. Okay. Quarterly data. Okay. There's a bit of a spike here on the, I think that's earnings. And that was in 2023. I don't 2023. I guess it's the fourth quarter, 2023, but it was kind of generally moving up and it just spiked up. Okay. Sales have remained fairly steady. Wasn't too much else to look at. 2024 earnings per share percentage increase, 86%. That's quarterly. Trailing 4 quarters, earnings per share difference is about 90%. That's earnings. Sales, quarterly is about 10% sales, yeah. And then trailing 4 quarters, 10% is about 11%. And that's it. Amazon is doing well. I would hold it. I wouldn't sell it. Not at this price. I'd wait until it gets about 300. If it goes anywhere near 100, I would buy more.
So Pierre, I have a question about the trailing 4 quarters. The last 4 quarters for EPS, pre-tax profit, and sales are all trending down.
Where? Oh, here? Yeah. But don't forget where we came from, right? This is just right off the the fourth quarter of 2023, but we came from 22, 21. Everything was just kind of a bit of a disaster, right?
Is that
Because of COVID, right? So we're starting from a low point. We started going up, but we know that next year is going to be a bit of a problem. That's why investors started selling, and the price dropped. Andy Jassy has told us that they're going to be spending more than $100 billion next year to build out the infrastructure.
So Christopher, in his Treasury's report, was saying that the Magnificent Seven are going to be trending down for 2020.
Yeah. Well, it was interesting. A little piece that I ran across. It was saying that Amazon will be spending more than $100 billion next year. Meta is going to be spending about $90 billion next year. Google is going to be spending about $75 billion. Microsoft is going to be spending about $65 billion. So where is all this money going? It's going to buy the AI chips. And the maker of that is NVIDIA. So NVIDIA, for the next 2-3 years, they're going to have a lot of customers. And they're going to be getting a lot of money. NVIDIA is going to do well for the next 3 years. After that, well, maybe not, right? We have to see. AMD is doing well, and then there are some other upcomers as well. So, but NVIDIA for the next couple of years will do well. And Amazon, it spends that money because Andy Jassy in his letter there said that that's the cash cycle for high tech. You have to build the infrastructure out first before you can monetize it, sell it to your consumers, and recoup your money. Now, Amazon, in contrast to a lot of other retailers and businesses, they make their own chips. They have contracts and deals with Intel. They have contracts with NVIDIA. They have contracts with Anthropic. They're using these companies to design chips in-house. Amazon has a chip called Trainium. They're Trainium 2. They're in the second iteration of that chip now called Trainium 2. They're working on Trainium 3. And what these chips, the Trainium and Inferentia, these chips are similar to NVIDIA's chips, but they're a heck of a lot cheaper. They're also less capable, but money-wise, in terms of performance per penny spent, they're about 30 to 40% more efficient than NVIDIA. All right. So in Amazon, if their customers want, big, huge databases, data information crunched, yeah, NVIDIA. But if they're just an ordinary mid-sized business, they don't need NVIDIA's chips. And they could use Amazon's Trainium or Inferentia. Also, what Amazon is doing is that they're building servers where they're going to be putting maybe like 100 chips or 1,000 chips of Trainium, or cheap chips, in that server, and building very capable servers, relatively cheap price. Some of the constraints that Amazon is running across, and many other chip makers and technology companies are running across, the constraints are power, electricity. And that was a couple of meetings ago, we talked about small modular reactors that are coming up in the United States, small nuclear reactors that they want to build because for that very reason. They need the electricity to do all these calculations on these expensive, power-hungry chips. Okay, so NVIDIA is going to do well. Small modular reactors are going to do well. Another constraint that Amazon has, and that many of these other technology companies will have, is the availability of chips. Amazon, in one of the talks that Andy Jassy gave, here is that they incorporated, I think it's a little bit lower down here, they incorporated, hold on. I saw it before. Okay, in the chips that they're putting together at Amazon, they've already incorporated DeepSeek, that technology, into their chips that they're building. Let me see it here if I can find it. The quote, I underlined it, but
You could probably do a search. Control F.
Okay, control. Okay, control F. Yeah, control F. Okay, DeepSeek.
Oh, you need to spell it right.
Oh.
Check your spelling.
Yeah.
You can probably just put deep.
Deep. Yeah. Okay. Oh, shucks. Okay. Okay, DeepSeek. Let's see if they find it. Where is it?
Is it one word or two words?
No, I think it's one word, right? DeepSeek.
Oh. Okay, so Piero,
Yeah.
I want to have enough time. We're already at 7. I wanted to have enough time for Christopher to do his.
Okay.
Okay.
Okay, there. No, not that.
Oh.
Not that. I underlined it because I wanted to show it to you. Now I can't find it here. Cranium 2 chips. Okay, it's getting close. Okay, here it is. In short order, we also just added DeepSeek's R1 models to Bedrock and SageMaker. Bedrock and SageMaker, those are the programs that Amazon itself has written so that people can use, their customers can use to write AI programs. And so DeepSeek's algorithms have already been incorporated into Amazon's products, which is pretty good, right?
Yeah, they're on top of it.
Yeah. They got the most money to spend, right? They're going to spend more than $100 billion next year, whereas the next big player, Meta, is going to spend about 90, 80. So Amazon is doing well. But, you can always overpay for a good company. That's the big mistake, overpaying for a good company. It's not so much what you buy, it's rather what you pay for it. That's the key, right? Don't overpay for something. You always want to buy something below fair value, and you want to sell it above fair value. And fair value is $270, according to Morningstar. So we want to sell it at a 300.
Okay.
Yeah.
Okay. So can we move on, or do you want to?
Yeah. No, that's it. Move on.
Okay. Christopher, are you ready?
Yeah.
Okay, I'm going to make you presenter. Thank you, Piero. That was awesome. You did a fantastic job.
Okay.
Yeah. So do you guys see the annual report?
Yes.
Yeah. So today I'll be presenting about Meta. Just going through some of the stock price stuff. So the purchase price was 198.94 cents average. We bought it like for the first time all the way back in 2017. And yeah, and we increased our position by a little bit, but recently we've been doing mostly selling to trim our position just because it's become such a big part of the portfolio. The closing price as of Friday was $736.67. The 52-week low is $414.50, and the 52-week high is $740.91. So we're close to a 52-week high. The current PE ratio is 3.3. The 5-year average PE is 21.3. The 5-year average low PE is 12.8. And the 5-year average high PE is 29.8. So the current PE is higher than the 5-year average high PE, so it's kind of overvalued in my mind. But yeah, we'll keep going. So the revenue, so this past quarter's revenue was 48,000 million. The year-over-year growth was 20.62%. The whole fiscal year was 164,000 million, or yeah, so 164 billion, right? And then yeah, and that's 21.94% year over year. Yeah, the total current assets is I mean, we can see the numbers. Yeah, okay. And then the current ratio, which is what we actually care about, is it's 2.96, and whereas like last year it was actually 3, so that decreased a little bit. Yeah, and that's mostly because they have a lot more liabilities. And then the free cash flow is 52,000 or 52 billion, right? Which is also higher than last year, and it's quite a lot higher actually. But yeah, and the SSG, most of the stuff is just kind of what we can see. So I guess we can take a look. Yeah. So the historical sales growth rate 10 years 26.5, 5 years 15.4. The quarter, so for the last quarter, it was 20.6%, and the trailing 4 quarters is 21.9. So it's not, it's like kind of out of its like crazy growth period, right? But yeah, it's better than the last 5 years though. Yeah, the sales forecast from the last SSG from last quarter was 15%. The sales forecast from the current SSG is 14%. The historical EPS growth rate is 20.2 for last 10 years, 19.7 for 5 years, and 50.5 quarterly, and then 60.5 for trailing 4 quarters. The earnings forecast from the last SSG as well as this SSG is 10.2. The diluted shares outstanding is 2 billion, 2.6 billion. And then it hasn't really changed from last year as well. The pre-tax profit, yeah. So pre-tax profit has gone, or it's like trending up, right? So this past year it was higher than the 5-year average. The return of equity is also trending up. This past year was higher than the 5-year average as well. The debt to capital, however, is also trending up, which is actually bad because they have more debt. So yeah, so it's 6% higher. Yeah, and then next year guidance. So they didn't provide a full year guidance, but they have a guidance for first quarter. They say it's going to be like 39.5 to 41.8 billion, which is 8 to 15% year-over-year growth, which is a little bit lower than what we kind of saw, right? Because we saw that last year was 20%. So that's something to keep in mind. Yeah, so no full year revenue guidance. The total expenses is going to be around 114 to 119 billion. The full year capex is going to be 60 to 65 billion, which is like mostly AI stuff, I would assume. And their tax rate, they estimated to be like 12 to 15%. And this is under their financial results. It's under page 2. And they didn't have any mergers, acquisitions, or divestitures over the past year that I could find. And then I guess their main news / features / products is they introduced Meta AI, which is built using Llama, their open source AI model. They introduced Orion, which is their first AR glasses prototype, and they brought to market like new styles and features to their Ray-Ban medical glasses that they're like really trying to market out there. Yeah, and my final recommendation, I guess maybe we should go over to SSG a little bit first before talking about that. So I mean, these are most of the stuff that we kind of talk about. I kind of went just with the analyst estimate. There was a couple other sources I was looking at. So like Value Line and Yahoo Finance is like 16%. But I kind of went conservative, so I went with 14, and this came out with 10.2 for the preferred procedure. And then yeah, and then here I could have crossed out some outliers, but I think the outliers, it's fine, right? It gives us a more optimistic approach, but even with the more optimistic approach, the upside downside ratio is still 0.9 to 1, so it's still not great of an investment. And the total return using high PE is 9.5%, and using average PE is 2.3%. So I guess the point I really want to highlight is that it is pretty overpriced right now. It's 30.3 PE, and yeah, and I mean, it's kind of insane. The 5-year average is 29.8. Yeah, so I think it's kind of crazy. And yeah, and then also along with like their products, right? I don't think like their AI model isn't actually that good, right? Like it ranks behind GPT-01, Gemini, which is the Google one, Claude's 3.5 Sonnet and DeepSeek and like multiple different evaluations is just not that good. And yeah, and like we can also consider their competitors, right? So like Google is actually pretty undervalued at the moment just because of the recent drop in price. And yeah, and I mean it just doesn't, the upside downside ratio just really doesn't look good for Meta. And most of their products nowadays, like it's not, there isn't much innovation if you think about it. Like Instagram Reels is like Snapchat Stories, Threads is like Twitter, right? Like they're just kind of trying to like, I guess like get other people onto their platform. But yeah, I mean their ad revenue is pretty good. They have more people, or like their ad revenue increased more in Asia and Asia Pacific and Europe last year. But their Reality Labs, right, which is like their kind of like their venture, it's still losing quite a lot of money, and with 17% increase of losses year over year from last year, which is like, how much was it? It was 5 billion operating loss. So yeah, so I mean, it's not that much compared to their ad revenue, obviously, but I don't know. It's been in the red for a while, and I don't know if there's actually an upside. But yeah, I mean, at the end of the day, it just comes down to how much you really think like they can profit off of their social media, right, and their ads. And I think, I don't know, I think they try to push like their AI so much, but it's actually not that good, and they're investing more into it, but it's crazy because it's not even on the forefront of like the AI runners. So I think it's, especially because our portfolio is like, it's more than 10%. It's the largest holding in our portfolio. So maybe we can trim a little bit. We don't have to sell all of it. But I do recommend trimming some of it, especially because it's like really high PE and it's at its 52-week high right now. But yeah, any questions?
Morningstar gives it a pretty good rating as far as their operating. They said they have record operating margin of 48% for the
Yeah.
fourth quarter. And then for their family of apps, and I don't use Facebook or whatever, so I don't know what their family of apps is, but their family of apps was operating margins were coming in at 60%.
Yeah.
So I guess their margins are, I mean, just like,
Yeah, I mean, their margins are definitely good because they also do multiple rounds of layoffs in a year. So they're cutting off a decent amount of expenses that way as well.
oh, that's what they're doing? Okay.
Yeah, I have a comment. From what I've read, Meta is not really like competing in the same way with AI as the Googles and Microsoft. I mean, you mentioned that their AI is not that good, but from my reading is they're using their AI on actually applying it to make their advertising more efficient. And they seem to be going on a different track than the other hyperscalers. And if you look at their stock price, it's still going up while all the other ones are either plateauing or maybe even coming down a bit. So from what I've read, Meta is doing everything right. They're not trying to create a general, what is it? A general AI, the all-consuming thing that Sam Altman's trying to look at. They're just receiving high marks for the applications that they have, and I think we ought to let it run. But anyway, that's my 2 cents worth.
Yeah, I mean, I definitely think they're more focused on the application of it instead of like having a model that other people consume. But I just think that maybe, I don't know, like during like the metaverse thing, right, a while back, like Mark Zuckerberg thought that like that's kind of the future, and now he kind of was saying that like AI will kind of replace engineers, right? I don't know. It's just, I guess, a little bit skepticism, right? I think at the end of the day, the PE is pretty high considering like the historical data, right? So I think that's kind of my main point, is that we can keep it, right? But we should probably trim it because we have so much of it.
Yeah, I
Okay.
think trimming it is maybe a good idea, but we still keep a bowl of it,
Yep.
most of it.
Okay. All right, we have like 13 more minutes left in the, let's see. Let me put it back to our agenda. Let's see, okay. So let's go to our open mic then. Thank you very much, Christopher. That was a really great presentation. I do hold meta, so it's nice to have somebody tracking it as closely as you do. Okay, let's see. Okay, so we're going to go to our guests. So Dinesh, I'm going to unmute you. Do you have any comments or questions? I see your mic's off. Can you hear me? Oh, now you self-muted. If you want to talk, I'm going to leave your mic. Okay. Dinesh? Okay, I'm not hearing you. But I'll leave your microphone on in case you want to say anything. Hi, Kirsty. You're self-muted. Do you have any questions or comments?
No, I have. Yeah, I came a little late, but interesting presentation on Amazon and Meta. That's what I heard. Yeah.
Okay.
Okay.
Actually, I'm going to mute you. Kirsty, we also have a YouTube channel, so we'll be posting the whole recording onto YouTube, and you'll be able to catch up on Jane's VRTX presentation too, which was also really good. Okay, let's see. Oh, let's see, Margaret. Hold on. Oh, or Margot. Hi, Margot. I can't unmute you. Let's see. Well, actually, okay, Margot has a question. For some reason, I can't unmute her. Let's see what her question is. Her question is, did you say you took 20% of the high PE to, oh, that's what the question I had. That was for Jane. So Jane said that was, yes, that's what she did. Okay. Oh, Mel, you're on there too. You're on as an attendee. Did we not make you?
Oh.
Okay. All right. So Dinesh, you're still unmuted in case you want to say anything. And then Margot, if you, for some reason, I can't unmute you. I don't, but you might be away from your computer. And then, is there any other comments, or we can go to our voting? Does anybody have any motions they want to make?
I want to trim a little bit of meta down to maybe 10%. I think we're at 11.4%.
Okay, let me see.
I will second it.
So how much, do we do that by shares?
Yeah, we can do it by shares. It's like a couple shares. Yeah. It's literally 2 shares.
Okay,
There,
Phil,
was there a second?
I
Yeah,
think
Yeah.
2 shares of Meta.
Yeah.
Can you believe we bought it at, how much have we made on that stock? A lot, huh? Okay. I'm just gonna leave it open for A week. I mean, till Friday? Should I leave it open till Friday, you guys, for voting?
Okay.
Okay. Okay, so Christopher, seconded by Jane. Okay. Okay. Is there anything else? Any other motions? I guess that's really the only, so Vertex was that a hold, Jane?
Yep. Yes.
And then what was Amazon, Piero?
Hold.
Okay, so Cell was Meta was Cell. Okay. Okay. All right, and then next month it sounds like, or is this an old one? Oh, this. Let's see. What Jay already gave the stock study. What do we have, Christopher, for?
I don't think we have anyone signed up actually for next month.
Let me take a look. Oh, was Piero and Reddy supposed to?
Yeah, we were supposed to do it today, but Reddy's not here. Reddy's going to be back on March the 15th, roundabout. And our next meeting is March the 17th, so there just won't be enough time. So,
Oh, so you want to do April?
April, sure.
Okay, I thought you guys were doing education, but
Yeah, we're just an education topic, yeah.
no, you're going to do a stock study.
Oh, okay.
Is that okay?
Yeah, for me, yeah, I don't know about Reddy. But
Okay.
I think it could be okay.
If you need somebody, I can join you. If you need somebody, I can join you.
Yeah, okay.
Okay, and then next month, oh, I should put Isla in here because she missed. Next month we have annual reports. Does this sound right to everybody?
Yeah.
Oh, you do? Are you doing it, Christopher?
Yeah, I'm
Oh, you do it.
checking
Okay, you do
Yeah.
it. Isla has RMD.
Yep.
Yeah. Thank you. Okay, so Hanny has CrowdStrike, Reddy has IPR, I have Schwab, Jane has ASML, Mina has Google, Mel is nice, and it's Isla's 1L.
Oh, okay.
Okay. Oh, actually, look on the left. Isla should be doing, I guess, is it quarterly she's doing, or is she doing annual?
Let's see.
And who's doing Taiwan Semiconductor? Is that-
That's me. That's Mel.
Oh, Mel. Okay, did you do that last month?
I did.
Okay. Just want to make sure you get credit for that. And then I'm taking, should Isla be on the quarterly or annual, do you think?
I think
Right.
it's actually quarterly because their annual was in August.
Okay. I'm gonna put, I'll fix this, you fix the other one. I can do this one. Okay. I think we're not gonna have education next time because there's too many annual reports. Okay. All right. Okie doke. Let's see, let's go back. Oh, education topic signups. And then, oh, did you guys already discuss the new forms for quarterly and annual reports? Did that already get discussed? Does anybody remember I wasn't here last time.
I think Haney had some outlines, and I can't remember the annual report form. Of course, I'm kind of new, so I've not seen an annual report form before. But
Do you need me to show you? I guess,
Well, I could pick it up. I'm sure it's on.
yeah, it's in the drive. So if you go to BI, templates. So I don't know
Okay.
if they made a new template. Did they make a new template for the annual report?
I don't think so. No,
No,
I
okay,
used the same one. Yeah.
let's just keep using that. This is the annual report template
Okay.
that you can use. Do you have brand new stocks, or are you taking a stock over from anybody, Mel?
Hard to say how I came about with TSM and NICE. I don't believe I took those over from anybody, as I recall.
Okay, so what we do is we go into earnings reports, and let's see, you have TSM, so it's not even, oh, here we go.
Do you
Oh.
remember who presented TSM?
I think I had ASML for a while, and then somebody else took it over. There's a big shuffle a couple of
Yeah,
months ago.
Jane has ASML, but it looks like you already did quarterly reports for TSM.
Yeah, I presented that last month.
And then, did you do an annual report already? Because it looks like Q4.
I did not.
Okay. All right. And then, so is that due then? Are they going to have an annual report?
Yeah, I mean, they posted their 6K of like 5 days ago. I don't know how useful that is.
Oh, Mel, they don't do a 10K, huh? They do something else. What's it called? When
It's
it's
called a
above-
6K or something like that.
Yeah.
Okay. So is that what he reported on? That must have been what you reported it on.
I just did a quarterly report.
Christopher, do you know if this is this the 10-6 or not? Or the whatever it's called, the 6?
I'm not sure,
Okay.
but
Let me look in, that's
Okay, you guys
my
look-
spot.
you guys
Let me
figure that out.
look into it and let me prepare an annual report.
Okay. Only if you have the information. Okay. And then I think everybody else is set. I think that they're following their regular, except Jane, are you new to ASML?
Yes, I will be preparing ASML.
Okay, quarterly and annual. Oh, you've already done it. You've already done a Q3. So I guess their annual's coming up. But everybody check to make sure, because sometimes when the annuals come up, the Better Investing isn't up to date. The Morningstar data isn't updated yet. So sometimes it gets pushed to the next month. Okay. Okay, we're at 7:31. I think we've done a good job. Okay, so the next month we're going to be doing, in March, we're going to be doing a bunch of annual reports and maybe Isla's quarterly. And so we won't have an education topic. And then the next month after that, Reddy and Piero will do a stock study, and I'll try to do I'll sign up for an education topic, but I don't know what it'll be yet. Oh, when is it? So we're going to do April. It's going to be Reddy, Piero. Okay. All right. Is there anything anybody else wants to add? Anybody want to say what stocks they're watching or any stocks of interest?
Well, I sent, this is Mel, I sent out an email and I put two stocks that I put up for possible watch list. One was VTR, that's the stock we talked about that was added to the competition. Vertiv Holdings.
What's it called? VTR?
Yeah, VRT, I think, VRT.
VRT? Okay.
Vertiv Holdings. So I put that in the watch, I think it's the watch list folder. I don't know the formality of putting on a watch list, and maybe it shouldn't be on the watch list. But then the other stock that I put up for, I guess, consideration was AstraZeneca. It's
What's
one
the
of the
ticker? What's the ticker on that?
AZN.
Okay. Well, when Reddy and Piero do their stock study, they can look at these. VTR and ACN. So Piero,
Yeah.
so make note of that. That
Okay, so,
I think it's VR. I think it's VRT.
oh, did I get that? Sorry.
It's VRT. Yes.
I think you said that. Okay.
I said VTR. That's why you
Okay.
put it there. My fault. And as far as I guess education topics, I know Haney uses ChatGPT and maybe other large language models, but the question I have is, how are others using the large language models to make stock analysis a little bit easier? And
Yeah, I've used it to try to do some screening. I don't think it does that great of a job, but I think it's just another tool.
right, well, and I'm looking at the different types of, there's ChatGPT, there's Gemini, and so forth. What I have found that's helpful is, these earnings call transcripts, just keep running and running. And, as Reddy's presentation or Pierre's presentation tonight, he went through there and highlighted things. But I found that you can summarize large parts of that. And the most interesting parts are when the analysts ask questions to the management. Some of them are pretty pointed. And I think that's kind of informative to look at. And anyway, I just bring up the idea of how can we use these large language models to make our jobs a little bit easier, and if people are using them, it'd be nice to hear about that.
Well, maybe you should ask Haney how he uses a ChatGPT to do it.
Well, I think he uses it many ways. Again, my use up to this point has been summarizing those lengthy earnings call transcripts. Yeah. And I found ChatGPT to do a pretty good job. And I'm just learning, basically I'm in a learning mode how to streamline that. But anyway.
Yeah, is anybody else using it? I've used it for some screening. So Mel's used it for summarizing earnings call transcripts.
I also use it to summarize the earnings call.
Yeah, just for future reference, I also used it. We had for our New York club, we had I guess, a program to go out and get new members. So we had a big, I guess, present. We had flyers and big advertising, and I used Gemini to help me out on that. So anyway, I think there's a lot of uses for it, And anybody else that has uses that want to share that information, might be useful to help others.
Anybody else use AI for club research? No? I think it's a great tool, and it's good to kind of start being an early adopter, because it's just going to get more and more powerful. And I think the sooner you start using it, and the important part, I think, what I'm learning is the prompts, that you really have to get pretty detailed in your prompts or your questions that you ask to get the better results.
Can someone do an education part on that, like shows how to do it?
Yeah, well, I mean, I don't know, Mel, how do you feel about talking about it?
I could share what I've learned. I know that that Google has, well, it's Google working through Coursera has two, I'm going to say courses. They're mini courses. It's self-directed. One's called Google AI Essentials, and there's an add-on to that, which is basically prompt engineering.
Oh, yeah.
And actually they close with how to create an agent. All right. So it's kind of really interesting. And, I could share the, I guess the links to those programs. So I'm willing to talk about those and just demonstrate that briefly. And
So Mel, I'm going to put you down for April. Okay.
okay.
Okay, thank you. That's awesome. And I'll try to do a little bit more research too, because I actually use AI a lot for my work. I do a lot of coding.
Yeah.
So.
Oh yes, that's especially helpful there.
Sometimes
and, what do you use to help you with coding?
Well, so at my work, we have a corporate account for ChatGPT, which is a kind of a closed environment. So the stuff
Okay, all right.
the stuff usually the stuff you share populates the universe, but it's only for our company. So it's like proprietary. Our stuff doesn't.
Right, but what you have access to then is the high-end ChatGPT, which is great. Yeah.
Yeah. Okie doke. All right, guys, I didn't want to keep going over, so it's 7:40, so I'm going to stop, adjourn the meeting, stop the recording, and if you want to stay on to keep chatting, you may. So I'm adjourning the meeting.